World Financial Group offers entrepreneurs from all backgrounds the opportunity to start their own business on a level playing field. Dr. Jana Woodhouse, receiving the WCM Wall Street Pioneer Award by the United Black Wall Street of America, Inc., is one of those entrepreneurs.
I see WFG and TFA as a place where African Americans with an entrepreneurial mindset can flourish. And the bonus, we help families and serve the communities across the country.
To learn more about us, go to worldfinancialgroup.com.
We are the sons and daughters of the soul. We are resilient and forever forward thinking. We ask for nothing else than the opportunity to live and to create the lives that we were meant to live. We want nothing but an equal chance at options and possibilities. The same possibilities and options to live out our potential as our fellow man. We want to be heard, understood, and expressive in our reality. We are the future. We are the creative. We are here.
She was told that she couldn't play with the boys. She was told that they were too big, too rough, too strong. She was told to give up her dreams and move on. She was told to just be pretty, be quiet, be a lady. She was told that women had to stay on their side of the court, stay in your lane. Playing and competing with men was insane. She was told that men and women would never be equal. Dreaming like that would only be linked to your mind, to your soul. She never listened. She knew that their thinking was old. She was magic. She is the definition of spirit. She is what champions are made of. She is now.
Greetings and welcome to Access Wealth Nation with Dr. Jana B. Woodhouse, giving you your checkup from the neck up on the finances. And so we, of course, are broadcast through Soul City Network and on WHCR 90.3 FM, the voice of Harlem. So I have this honor today where, as we're getting closer and closer to the end of the year, I felt that it was so necessary to cover as we leave this year, to know some of the things that we have to prepare before the year is out to prepare for your taxes. I know I'm saying a serious word. Hey there, Aline. Thank you for listening all the way from Japan. And so we are at that stage. If you have any questions, comments, thoughts, please just add it in the comment section. I'm glad to be on today. So much is going on in our world. Of course, I want to cover the things that, do housekeeping. We have the How Money Works, Stop Being a Sucker book, written by two of my associates and partners, Tom Matthews and Steve Siebold, up to over 500,000 in distribution. So it's about getting the word out. So if you'd like to have a free copy of the book, all you have to do is email me at anagenterprisesinc@gmail.com. And please provide your address. It is a physical book, so I have to mail it out. So please provide name and an address that we can mail it to. I have had the joy of sending out so many books and all over the countries, which means that we are impacting the world of finance and getting people to understand how money works. Now, of course, when you get the book, all you got to do is one thing: read the book. It takes maybe about an hour or a little more to read. It's got full of pictures and diagrams and stuff. So sit back. Matter of fact, since everybody's getting together with their families during this holiday period, share it. Share the book. Share the information that you learned. It's definitely, I have never had anybody who read the book and said, I ain't get nothing out of it. So therefore, read the book. But again, if you have any comments or thoughts, you can always just tag into the comments section and I'll get the information to you. Also, for those of you, who are in that position that would like to have what we call a free financial analysis, FNA, or what we call the discovery call. And what's the discovery call? Well, if you read the book, it says this will tell you where you're at, and this will tell you as you get the financial needs analysis where you're going. There's always a necessity for a roadmap. When we go on trips, we've got to have our own GPS, a financial GPS. That sounds good. So that's the whole element is that if you have a plan, then you're planning not to fail. But if you don't have a plan, you may be planning to fail because you need to have that roadmap. So you can call our office at 646-375-2121, or you can email me at anajenterprisesinc@gmail.com. I'll be glad to set up a time. And if not me, one of my associates will be glad to go through and we send through a financial needs analysis with you, but also to send you the information necessary for what we need to use. So last week we talked about that, was about the financial needs analysis and what does it entail? Because it's like going to the doctor. I just have been going to the dentist recently for special care. And, that I'm going to have that dentist on, Dr. Jana Williams here in Harlem, because it's so true. We do not plan to have to pay money for the dentist. And in the end, as we get older, we need to pay to get the care that we need. It's not, the insurances don't usually cover. They'll cover a cleansing. But that's another topic. I just wanted to let you know what's coming forth. Also, I believe next Thursday we're going to have a filming from the restaurant in Harlem, Shrine, and we're going to be talking about financial stability and wealth. So stay tuned, listen out for it. It is one of those things that we don't talk enough about. Unfortunately, financial literacy, 66% of the individuals in this country, in this great United States, could be considered financially illiterate. And how so? They don't even know the basics of like how your money doubles, the rule of 72, how insurance works, how to create an emergency fund, how to build wealth. That should be something that's taught in the schools, but there's only about 27 schools in this country right now that teach financial literacy. And of those schools, guess what they teach you? How to balance a checkbook. Really, we don't even have checks anymore in these days. So it's not in a situation of really getting you financially literate. Teach about how you can make your money double. Teach about insurance policies. Don't you all agree that this is something that people need to know? Teach about the difference between a retirement plan and a non-retirement plan. And what's the difference between a stock and a bond? We hear all of these things. We hear about the market, but do we know? So financial literacy is so important. And then once you become an investor, you have to really be aware of how taxes really affect your investment and how it affects your future, your plans and your goals. We have to have, unfortunately, in addition to putting together our plan, we have to have Uncle Sam. And here in New York, we have Aunt Hokel. Okay. And then we have Uncle Adams. So it's one of those things of where we have to really concentrate on putting our plans together. And I want to shout out to Tyrone Glover for Leverage Your Credit Recovery. Hi and happy holidays. And I'm saying happy holidays to everyone because it is holidays, because people don't treat it. It used to be, it is a holiday, but they treat it like a holla month. And matter of fact, about 3 months out of the year, because we're buying and buying and buying. And then what do? We return, we return. But also what we do is that we go out and buy. And I will tell you that studies have been done that the average person remembers who they were with, but not necessarily remember what they got from the previous holidays. So think about that. That means that people are very important to you, and what they say and what you do, and the gifts, the tangible stuff that's just stuff. I was listening to a radio show today, and one of the aspects that someone said is, the things you shouldn't do, like not give that fruitcake that someone else gave you to somebody else, like the passing of the fruitcake, funny things like that. But the bottom line is that spend the time together. It is really a rough time. And why? Because we have this inflation still taking place, and inflation is our buying power. Gas has gone down a bit. The market itself is still going up, down, up, down. You need some stability. And that's why it's so important to sit with a financial educator or a financial planner. I would say a financial educator. And the reason why, just like we talked about last week, was the fact that a financial educator will educate you. Then they may be able to prescribe, and yes, I use the word prescribe like you do with the doctor. They may be able to prescribe a solution for you, but first they need to educate you, and you have to be in that position and open your mind. And then after they educate you, do something. That's what we need to do in this day and age. Do we see the market straightening out? Probably not next year, I'm going to tell you. So those of you who are preparing for retirement, you need to sit with someone, a professional, ASAP, because if you're getting ready to pull money out of your retirement, you've got to prepare for it. If you've got some time, then what you do is, like 3-4 years, then sit tight, but still sit with a financial educator or planner, because this market is not the norm. And we've seen it happen. We've seen this before. We saw 2008. We've seen where the market was bottoming out. And just to give you a little bit more education here, do y'all know what the Dow Jones is? It's only 30 companies. It's a test of the market. It's not the entire market. But we go haywire over the stock market when it starts to drop. Well, what happens is when it drops, you should be adding money to it. Buy low, sell high. That's what's necessary. And you should ingrain that in your brain. You should also put it on the mirror in the bathroom. Buy low, sell high. Do not do what normal people are doing these days, is selling low, buying high. Just can't get them off that track. All these years that I have been dealing in finance and accounting, still can't get folks to stop. But that being said, we talked about the little element. I said that statement, taxation. Taxes are a part of our life. How is it? When we make it, they tax it. When we spend it, they tax it. Guess what? When we die, they tax it. So there's ways around it. There's ways to minimize it. But until you understand the jargon and get on board, what happens in our communities, and I'm on my soapbox about it, we will work and give the government our money, and then we ask for the refund. If we get I'm waiting for my refund. I'm going to pay you when I get my refund. Well, you think about what a refund is. A refund means you gave somebody too much money and they're giving it back to you with no interest. Who does that? It's one of those things that we've been taught by our parents, our associates around us. Why? Because we were told that if you get a refund, then you could go, that's a savings program for you. Tell you, this is just, I can't even make this up. So instead, if you calculated properly and took out just the right amount, or maybe get to the point where the government owes you $1 or you owe the government $1, and then they don't take that. You can do that if you plan properly. And that excess money that you get, guess what? You could start to put that towards your financial plan. It could go towards an insurance policy. It could go through a mutual fund. It's the gamut. You can put money away towards your goals, but you can't do that if you got it all tied up in the government. It's just like, and I don't have it. Wait a minute. Let me do a disclaimer here. I'm not begrudging the government getting money. I'm just begrudging them getting my money. But I'm not begrudging them. It's just that they should just get what they deserve, not more, and hold it for a whole year. And then after the whole year, then they give it back, no interest. That's what I begrudge. Okay. So we do want to pay our taxes, no doubts about it. But there are things that will allow us to get some breaks, get some tax breaks. And so we're going to talk about that today. We're going to go through a few things. And so the first thing we're going to talk about, we got to file our 1040 if we are individuals. If we have a business or a partnership, that's another story. And I will address that in another program. And we also need to address, because I don't know what's happening with you guys and y'all want to set up businesses, but all y'all know is an LLC. Don't know how it's going to be taxed. Don't know how you're going to deal with any partnerships. Don't know. So the bigger part is don't fall into that rut. Sit with a professional. Get your team together. You need a good lawyer, a good accountant, and a good financial advisor. That would help. That's your team. Now, you don't have to be in a position where you have them on retainer continuously, but if anything, be able to have it so that they can answer some questions for you. And so that being said, we're going to talk about itemizing deductions, because once you get all your income on the page, all the wages, the interest, if you had pensions, all of that stuff, if you had Social Security, which I'll probably mention a little bit about that. Did y'all know your Social Security could be taxed? All of this is income. And so now we're going to the slides that say itemized deductions. Let's talk. What is an itemized deduction? So we already should know that we have something called standard deduction. That means you don't have to prove anything. And for a single person, it's like $12,950. And that's right off the top. That's called, we used to call it a short form, that you didn't have to prove anything. You just needed to take the standard deduction that the government gives you. Now, they give you a little extra money if you're over the age of 65, or if you're blind, they give you some extra money to deduct. But the bottom line is that's standard. If you're, not self, but if you are a parent has a dependent child, that's called head of household. So That's another element that you can look at. You may get a little bit more of a write-off, standard deduction, or if you're married filing joint. It's really interesting about married filing joint. There's a lot of perks, but there's also some things that you don't get or that you can't write off. So we're going to talk a little bit about just what this is all about. And then, of course, you have married filing separate. There was a lot of people during COVID, they didn't want to file with their spouses. If you lived separate for over 6 months, you can file separate and single. But if you lived in the same household, just married filing separate, and you don't get a lot of deductions, it's almost like you were single. So be careful about this. So let's talk about some standard deductions. I mean, not standard, the itemized deductions. The first one is at the top of this page, and I hope you can see it. It's called your medical deductions. People bring continuously their medical deductions. They have the dentist. They have their prescription medicines. If they use hearing aids, even if they had to do dentures, they can bring all of that to you. But if you look, and it's right there on line 2, no, it's not line 2, it's line 3. It says it has to be over 7.5% of your income. So if you had a taxable income, or what we call adjusted gross income, of $100,000, you'd have to have medical bills over $7,500. And if you had 7,501, well, you only deducted $1. So you have to get them together. You can bring them to your preparer, who's going to prepare your returns, or if you're preparing your returns, you can definitely take that to them. But when you have them already added up, also to let you know, in the medical side, as expenses, you can also deduct the use of transportation for medical. That means you might have had an ambulance come, or you had to take a cab continuously to your doctor or to your dentist, So those things are deductible, but it has to come over 7.5 for it to count, which means you probably need to be really sick. Either that or you have dental bill, because dental can really take it to the heights. Then we have what's called the next level. The next level is your state and local tax. I think I covered all of the expenditures. Maybe I could just let me go through medical a little bit more. I left out a few things that I wanted to say is that those are also payments for the diagnosis, the cure, the work through it, the treatment, the prevention of a disease. Also, in some cases where women need to do an in vitro to help them become pregnant. These are some of the things that are deductible, but again, it has to come over 7.5%. While we're in school, we think, what is percentages have to do with anything? That's what this has to do with, is the percentages that you need to be able to figure out when someone says 7.5%. So now the next level is your state and local taxes. If you see that. Now, what's state and local tax? State and local tax, as if in cases of, is your state and the local income tax. When you look at your page stub and you see the state and local city have taken out taxes out of your check, out of your pay stub, out of your paycheck, that's what we're talking about. So those are things that are deductible, but also some of the state and local taxes generally are 4 types. They got the state, local, and foreign. Yes, you can have foreign investment tax. That would be added in there. You have your general sales tax. That's also added in that state and local tax. Estate taxes that you may pay. real estate tax. Uh, that's your state and local real estate, because we pay real estate tax. Those of you in Long Island, praise the Lord, y'all are paying some serious tax out there. I've seen it happen. And also, if you paid taxes the previous year, during the year, in state and local tax, if you had to pay them back money, those are all to be deducted. So these are things I call attention to. Now, there's another little stipulation here that can really be depressing, is the fact that it can't be more than what we call, the state and local taxes called SALT. And it can't be more than $10,000. So if that's the case, then, and you paid $12,000 in state and local tax, you got $10,000 to claim. So that's it. There's no more that you can claim. So that has hurt a lot of people. And I will go on my little soapbox and say to you is that if that's really the case, you need to talk to your congressman and your state senator, your not state senator, the U.S. senators, and tell them stop this, because this was something that was set up through the previous administration, and it really is hurting a lot of people in the states that have state tax. Now, there are some states, as a matter of fact, there's 9 states that don't have state tax, and that can help because they don't have to pay it. But here in New York, we're one of the highest taxed places in the entire country. So in respects to that, you might want to make some noise about it, but that's a deduction, and I'm trying to see to make sure that I got that out of the way. Let me bring forth the next one, which is your mortgage. People own co-ops, condos, townhouses, houses. If you haven't fully, well, in a case of a condo or a co-op, it could be that the condo itself or the co-op owes still a mortgage, and you might not be owing the mortgage personally. You might have paid off your mortgage. But on a general sense is that mortgage, you'll get that statement to show what the mortgage interest, and if there's additional expenses, which is called the premium mortgage tax, well, that's gone out the door. But if you used to could deduct that, that's not so now. If you have an equity loan, which a lot of people do, they take equity, because there's only 2 ways you get money out of your house. So you either are going to take it because you're selling the house, you get money out from the fact that you bought the house at a certain price and then you sold it. So that's called a capital gain. That's a possibility. But then there's another way of getting money out the house. It's called an equity loan. My house, I've paid majority of my home off, and it was $100,000, but the value of the home is $600,000. So that difference, that $500,000, that's equity. So you can take an equity loan. Here comes the situation with the equity loan. The tax law states if you have an equity loan, are going to take an equity loan, you've got to spend it on the house. Now, years back, up until that previous administration, you could take an equity loan and pay off your credit cards. You could take it and pay the medical bills or the dental bills, as high as they are. But the thing is that if right now, the way that it stands, you cannot deduct the mortgage interest if it is a case of where you took it for those purposes. Now, if you took it to do home improvement, you could do that. If you're getting ready to straighten up, do the basement, or you're putting on a new boiler, things like that. Yes, you can take it, but you have to be able to prove it. Now, I've had situations of where I've fought with IRS, and I will say is that if you took the credit card and used it only for the home improvement, then you can prove that and show that that was just for that credit card was only for home improvements. Then you can pay that credit card off, but it has to be the same year that you got the expense. Pay it off with the home equity, and that considers a home improvement. But it's a fight. But that's a legitimate fight, so be careful. Also with the home mortgage, unfortunately, if you have a home and you purchased one this year and it's over $750,000, that portion that's over the $750,000 that created interest, not deductible. Okay. I don't know why they picked 750. That's another dig against New York, because we have homes. That's what the homes are right now going at, a million plus. And how in the world are you supposed to not take the deduction for the interest? That's just so unfair. But that's what we have. And I thought that Congress and the Senate would start to vote on some of these aspects, but instead they're going on vacation. So this week that's it. They're done. So we won't get till we get the new Congress and the new Senate, and they vote. So this is some of the stuff that you need to bring to your local politicians and tell them that you're not happy with the fact of that you can't deduct your full mortgage interest. You paid it, but if it's found, and some people say, well, I'm going to take it anyway. Just if you ever get audited, they will remember, it'll draw it back. So it's not worth doing that. The next thing that we're going to talk about is gifting, because I know I only have a short period of time to talk tonight, but I wanted to do this itemized because people don't know the difference between itemizing and standard deduction. So the next level is gifting. Little change in the tax laws. There was a time that you could take a deduction if you gave cash and you kept a record of the cash in a ledger or a book. Now, if the deduction is over $250, you have got to show a receipt. So all the time that they're passing the hat or the basket at church, you need to put that in an envelope, and you need to write a check. If you're not writing a check, then contact the church and see if they take Zelle or they take Cash App or any of those other entities. I don't know if they take PayPal and all of that, but you need to be able to prove that you gave them this money in a receipt. Now, some churches will give you a statement at the end of the year. What did you tithe? What did you give to the building fund? What did you give to the minister fund? Whatever. That all can qualify as a deduction, but it cannot if you can't prove it. So up to 2021, we can basically make a statement and show a ledger. 2022 filing, you have got to be able to prove that this is a qualified deduction. Now, the cash amounts, depending upon, how much can I give? I have folks who say to me, what's the maximum I can take? So to answer that, the deductions for charitable contributions generally can't be more than 60% of your adjusted gross income. But in some cases, 20, 30, 50% may apply. So you be very careful. Like in the case of If you go to, let's say, a dinner that's given by a nonprofit or by your church, well, the dinner might have been $50, but the cost of the dinner was $30. So all you can deduct is 20. That's what you can deduct. The $20. That's a percentage. And that's because you have the limit of what did you really contribute? Well, it went in your belly. So therefore, you can't deduct that. But you can deduct what you gave to the nonprofit. So in some cases, the 60% limit is eradicated, but for the most of the part is that you need to be able to prove that where this came from, the address, the name of the nonprofit, and the address and the date that you gave the contribution. You need this in writing. Now, I'm going to say is that it makes it very difficult for people who have nonprofits. But if they say they're a nonprofit, they need to be on the IRS list. Yes, there's an IRS. You go to the publication. I don't have the publication offhand. Let's see if I have it in my notes. But you need to have the publication. You have to need to have the receipt as the publication, and that they are in the listing of nonprofits. See, people say I'm a nonprofit, and then what do? They tell you to donate. Okay. But then when you go to IRS, they never got the certification that people could donate to them. That's a certification, and it takes a little while to get. So you have to look, because if not, it will be not deductible. The other thing is for non-cash donations. You know, the Goodwill, the Salvation Army, I forgot the Houseworks, the disabled veterans. You know, when we give away clothes and we clean out our closet and we clean out our kitchen from appliances and stuff, we give them away. That's nice. You have till December 31st to do so. So in doing so, what do we have to do? Now, I'm going to tell you what you need to do, and you can, because you and I and IRS know that they give you a blank receipt. You can't go by that. What you have to do is you get a listing, get a pen and paper, and write out everything that you gave. I gave 3 shirts. I gave 4 blouses. I gave 3 pairs of pants. I gave 8 pairs of socks. Everything has a value to it. And what we do is that we utilize the thrift shop pricing, because most of the places that you give to are getting ready to give it or sell it. So you have to go with what the market value is. I know for a fact that one of them is with the pants. You have a pair of pants, whether they're male or female. I don't care if you spent $500 for it, you're not getting any more credit than the $12. But it adds up. It can add up. So what you do is that you get the receipt and you attach, which the receipt should say when did you give it, what the address was that you gave it at. If it's not written on there, make sure it's written on there, that it's a valid place. And hopefully they will stamp it for you. Usually Salvation Army will stamp. I know Goodwill stamps. Usually with the disabled vets and St. Mary's Church, they don't stamp, but they leave you a card telling you how much did you give, 3 bags, 4 bags. Now, in this thing with the bags, you've got to take the time and itemize how much did you put in. Now, it can be your preparer who will make the decision of the market value. Most of us carry a sheet that will give us a determination of what the value of what you gave away. So just by saying that you got, gave away 10 bags, that's nice, but it has to be itemized. If you're not willing to do that, then it's going to be just regular standard deduction, and you won't get credit for it. Those are the things that you need for $250 and above in a deduction for contributions. Now, some people contribute more than that. They will contribute a piano or computer equipment. You have to get that appraised to say what it's really worth. So those are the things you have to. I know I had a client of mine years ago who had a piano, and the piano was appraised at $5,000, but we had the slip that showed that it was appraised at $5,000, and she was able to take the deduction. So those are the things that you can deduct, okay, and how you have to go about deducting it. You have to put, matter of fact, you should start now putting things together to your deductions. And if you're going to give something away by December 31st, no problem. But make sure you itemize and have a list, and preferably on that list, when did you buy it, roundabout, and when did you donate? Those are very, very important. So in saying that is that deductions, cash deductions, non-cash, cash and check, all of those need some type of proofing. And so you have to be aware of what you're doing, because IRS will come back and say, prove it. And then, when it comes down to your preparer, I know there are people who just say, I'm going to my preparer because they just write down anything. You won't see that this year because there's a lot of changes and a lot of responsibility put on the preparer to make sure that they can prove. And they will ask you, because the onus is on you. Now we have some things where we've had some major disasters, and there may be similar to what's happening tonight, and not here in New York, but maybe in other places where the snowstorm has created great catastrophes and casualties, and that loss. There's a rule behind a loss. You just can't take the loss. You have to first have the loss itemized and identified. And then once you get the value of what the loss is, what did the insurance company give you? Or did they give you anything? And then the second thing is that they're going to deduct off the top, no matter what, $100. I don't know why. They take the 100 out because they figure you did get, even if you said you didn't get any insurance money, they take off $100. So in doing so, you have the opportunity to deduct whatever's left over 10% of your income, your adjusted gross income. So it's not easy as it seems to deduct under a disaster, but the biggest part, it has to be declared as a federal disaster. So you can't just say, oh, I got, I had a storm go through. It has to be designated. That's why you hear when the president has designated a federal disaster loan, a federal disaster period, not loan. At that point, then you have the right to take deductions. But if it has not, then no. And that goes for the floods, hurricanes, tornadoes, fire, earthquake, volcanic eruption. If that happens in New York, I'm out. Okay. So these are the casualties that could happen. And they're not the normal situation. So it's not the normal wear and tear of your property. Okay. That's the other element. Now, I've had folks come and they talk about moving expenses. Okay, there is no moving expenses, where your job makes it mandatory. If you are going to get a job and they told you to that you had expenses because you got to move, so you're in New York, but you got to move to Georgia, have them pay for it. Have them pay for it. Be part of your contract. Trust me on this, because if not, unless you are a member of the armed services, there are some stipulations that will allow you to. They have to be on active duty, and they have to move pursuant to a military order, and or an incident or a permanent change of station. And also the moving expenses would qualify as a deduction if the employee didn't get any reimbursement at all. If that's not the case, no deduction. It used to be whereas you just had to move within a 50-mile radius and have to relocate. It's not the case right now. This is as of 2018. You knew who was president at that time. And this is going to last till 2025. A lot of the CARES Act and the laws that went on taxes, a lot of it has to do with the rule of the CARES Act. That's what it's like. That's what it is, and it's not to go away unless Congress and the Senate changes it. That can happen. But so far, they're not even having discussions. They're talking about the inflation and the military situations that are going on. So that being said, moving expenses are not the general deduction that you can get. It used to be a pretty good deduction. Also on the, which we'll cover at another session about IRAs, because that's one way. Some are deductible, some are not, but I'll cover that because that's a big part. That's a very big area. I'm trying to see what my last little bit on here was. There are other deductions that can go on your itemized deduction page, but will probably not be deductible on the federal side, but on the state side. And many a times we have to put that on as accountants, is to put those deductions on. What's that deduction? These are the work-related expenses, the union dues, the uniform, and please, please, please understand that a uniform has the company name on it, cannot be used for any other attire outside. So if you work for a job and it says you must wear black clothing, waiters, those clothing could be used in everyday wear, unless you can truly prove that it's never used for nothing else. And that's really a tough call. Back in, I think it was 1985, a gentleman who did not wear a suit for any reason at all, would not do it, but his job made it mandatory for him to wear a suit. And he got testimonies and affidavits. And finally, he won after years because he had the suits and the cleaning of the suits. That is a rare occasion that happens. But I just wanted to call attention that sometimes those things happen. So you have the opportunity at that point to deduct. But on the norm, no. Your union dues, your uniforms, your uniform has to have the company logo on it. There's a one bank out here that really did a good job with that. They made their ties with the logo on it. The ladies have their vest on with the logo. I'm not going to name the company, but that's what they have. And so it is business attire, unless you want to walk around advertising that company, you know. So there are some ways around it, but for the most part, it has to be a uniform that is identified with the company logo and used only during your company work hours. The other things that are out there that are deductible are like your investment expenses. Many of you may have investment expenses, sales charges, 12B1 fees, which are fees that are internal fees for having an investment. Those things are deductible on the state. Also, your safety deposit box is still deductible, but only on the state. So those of you who live in those 9 states with no state tax, not happening. Okay. So those are some of the things that you can look at. There are some things that what we say is deductible above the line and some below the line. These are the things that are below the line that bring down your income. Now, if, for example, because standard deduction for a single person is $12,950, if you are have less than that, then go standard. That's just the way, make it easy. But if you have more than that and you've had some catastrophes take place, you've had some serious medical bills that you paid, let me emphasize that also. It's not just getting the bill, it's what did you pay? What do you have proof that you paid? How do you have proof that you paid? Is it that you have receipts or credit card receipts that identify that as a expense? Those are the things that you have to, and your preparer will have to go over. That's why when you get to that standard of just, I'm just turbo taxing it, or just throwing numbers in there, that's one. But the reality is that a lot of times you are able to get more deductions by going to a professional. Just as a note, when we talk about adjusted gross income, I might as well throw it in because I know there are teachers listening to me. Teachers get automatically deducted from their income if they've made expenses related to their job teaching, $250. I know it's not a lot, but that's done above the line. So that comes off the top if you can show, and anything under the line would be the excess. So if you spent $1,000, you still would get the 250, but the extra would go towards the state tax return, just as a note. So as we're narrowing down, let me cover what record keeping, because this is another thing. It is mandatory that you hold a copy, whether it be an electric copy or a physical copy, because many of y'all are just like, I want to get rid of paper. Let me run down what's mandatory. Keep records for 3 years when you're filing tax returns. And then if you keep records for 3 years from the date that you filed the original return, or 2 years from the date that you paid the tax, I say make it easy, 3 years. You need that. So back date, look at the date. We're getting ready to prepare 2022 tax return. So that's 1 year, 2021 and 2020. Now, let me call attention. You have till December the 31st. That's next Friday, I believe. No, next Saturday, to file your 2019 tax return. You can still file for your refund, but after that, you're not going to get that refund. Just know that. So the best thing to do, you should have filed before, but as the time is narrowing down and that year is going out, and we can't e-file it, so you're going to have to make a copy of the tax return and get it stamped by IRS. Well, they're not open on a Saturday, okay? They may be open part of the day on the 30th. So if you really are due a refund, I think you need to get busy and get to an accountant and see if they can help you out for your 2019. 2020, you still have time to claim a refund, and of course for 2022. So that's my take on it. Is you should hold your tax receipts and your returns for at least 3 years. Now that means that you can scan them back in. Some preparers like myself have a portal that you can put it in. You can scan it and put it in a cloud. Definitely make sure that it's password protected, because the identity theft out here is running rampant. 7 years, keep records for 7 years. If you claimed a loss of a security, or also if you have business tax returns, keep records for 6 years if you do not report income that you should report, and it is more than 25% of the gross income showed. So keep it to show that if you did not report income, which you should, because there's a penalty for that. And don't think that IRS is not going to charge you penalties, because they are hungry. And they are, for the least little thing, they are charging penalties for not filing on time, not paying on time, not paying enough estimated taxes. Did you cover enough? So please get your tax information early and make sure that your accountant or your tax preparer is checking to see if you're going to have to deal with penalties. You would keep tax returns, like I said, 3 years, 5, it could be 7 years if you think that there's something that was done a little bit shady on your return. You may want to amend that. But those are the things, like it says here in the manual, it says keep records indefinitely if you filed a fraudulent return. If you filed a fraudulent return, at the end of your return, it says, I, under perjury, am giving this statement of truth. I suggest you hurry up and amend it and clean that up. Keep employment tax, those of you who have businesses, for at least 4 years after the date that the tax becomes due. That and sales tax, to prove that you have it, for at least 4 years. But for your general income taxes, it's okay. You can keep them for 3 years and get rid of them, shred them. As accountants are concerned, most of us keep for 7 years. And after that, we can get rid of them. We do our best because of what goes on and how rampant identity theft is. We do our best to make sure that your files are protected. As a matter of fact, it's mandated that we show that we have protected your identity and your information, because if we haven't, there's a $500 per return penalty for us. So this is a serious situation of what's going on in our world today, and everything electronic. So I just say to you is that interview your preparer. If your preparer is not asking you questions or has a questionnaire for you, run, because they're not concerned. They're about just doing the money. So don't let that happen. And if you need assistance, you can always call our offices, of course, at 646-375-2121. We're nearing to the end. I hope you learned something today. And if you have other questions, you can always reach out to us. And so I will say this was a pleasure serving you with, and this is Jana B. Woodhouse, Dr. Jana B. Woodhouse, giving you that checkup from the neck up, hoping you understand how money works and then act upon it. So y'all all have a peaceful and safe good night.
She was told that she couldn't play with the boys. She was told that they were too big, too rough, too strong. She was told to give up her dreams and move on. She was told to just be pretty, be quiet, be a lady. She was told that women had to stay on their side of the court, stay in your lane. Playing and competing with men was insane. She was told that men and women would never be equal. Dreaming like that would only be linked to your mind, to your soul. She never listened. She knew that their thinking was old. She is magic. She is the definition of spirit. She is what champions are made of. She is magic.